In this video, I'm going to go over the step-by-step process of how to invest in index funds. Index funds is one of the easiest, most passive ways to invest your money in the stock market, and it allows you to diversify your portfolio much greater and have much less risk and still get a great return. A lot of people, when they're thinking about getting started investing in the stock market, they think that it may be too hard for them because they don't know anything about how to value a company, how to look at financial statements, how to do this and that in order to make sure they don't lose money. But what if I told you that instead of worrying about that, if you just bought one investment over and over and over again, you can be well on your way to being a millionaire? And what I would recommend everyone do when they're getting started investing in the stock market or any sort of investments, whether it's real estate, whether it's bonds, whether it's anything, is to review your finances so you have a good idea of where you stand financially. You want to sort of view this stage as a report card stage. You're reporting on where you are right now. Do you have too much debt? What is your income level? How is that projected to increase, decrease, or stay the same in the future? And if you skip this step before you get started investing in the stock market, you may be putting yourself at a greater risk of financial burden, because I personally wouldn't encourage anyone to invest in the stock market if they didn't have an emergency fund first, or if they had double the amount of credit card debt as the average American, because 9 times out of 10, the return that you can get from paying off bad debt far outweighs anything that you can get in the stock market if you invest in index funds. So take a fine-tooth comb and go through your finances so that you know exactly where you stand before you get started trying to invest in the stock market. But once you have reviewed your finances, you did want to decide to yourself, why invest in index funds in the first place? In a world where there are so many investment options out there, you can choose to invest in real estate, you can choose to invest in individual stocks, dividend stocks even. Why choose to put your money in index funds? And although there are a lot of opinions out there, my personal reason for investing in index funds is that it allows me to get a chunk of the overall market, of the overall economy, for a fraction of a price. If I wanted to invest into the S&P 500 by actually investing in the top 500 largest companies in the United States, I would have to go through and buy shares of each individual company, all 500 of them, and then rebalance them as they're weighted in the S&P 500. And although that may sound like an entertaining video, I personally don't have the mental capacity to do that, and I wouldn't recommend anyone take such a manual approach to investing, because it just introduces so many new unnecessary headaches than if you just invested in an index fund. And the index fund is doing exactly what I just said, where if you invest in the S&P 500, it takes that overall market and puts it in a package as one big investment and sells it out in many slices. So in this scenario, if you bought an S&P 500 ETF, you could buy a slice of the overall American economy just for $50, depending on what the price of that index fund or ETF is. But even though I personally mentioned S&P 500 a lot on this channel, there are a lot of other different investment strategies that you could potentially use if you didn't want to go to an S&P 500. And for those that don't know, the S&P 500 is basically the largest 500 publicly traded companies in the United States. So at the top of this list, you're going to have your Teslas, your Apples, your Microsoft, all of the biggest market caps that you can think of that are publicly traded in the stock market will be included in S&P 500. But there are other indexes that you can choose to invest in, such as the Russell 2000, which tracks the smallest 2,000 publicly traded companies in the United States, or you can invest in a NASDAQ index fund. A reason why a person may want to invest in the Russell 2000 outside of S&P 500 is that they may see more growth potential in investing in the smallest 2,000 publicly traded companies instead of the more stable, less volatile S&P 500. And if you chose to go the NASDAQ route, you will be much more heavily weighted in the technology sector of the economy rather than maybe evenly weighted across the whole industry. So in this scenario, I would definitely recommend that you educate yourself on what investment style fits you personally. What fits your risk profile as an investor? Do you want to be more heavily weighted in banks, or do you see the future of your money growing with technology? Whatever that case may be, if you do a deep dive on your own personally, you will be able to make a much more informed investment decision when it does come time to put your money on the line. But let's just say you did want to choose the S&P 500, which is one of my favorite funds to invest in. You can't just go out and buy the S&P 500. What you have to actually do, as mentioned by this video, is buy an index fund or an ETF that tracks that index. And I show this exact process in a series on the channel where I buy the index tracking ETF VOO or the Vanguard S&P 500 ETF, where it tracks the S&P 500. And the reason why you have to buy an index fund or ETF is that these are the companies and the managers that put these portfolios together. They rebalance them, and in exchange for providing that service for you, they then charge an annual fee called an expense ratio. Nowadays, expense ratios on index funds or ETFs are extremely low. You can find them anywhere between 0.05% and 0.01%, but they used to be much higher if you wanted to invest in an index fund. So for the Vanguard S&P 500 ETF, if the expense ratio is 0.01%, that means that for every $10,000 I invest, I would have to pay $1 out as basically a management fee. And although that is very small in the grand scheme of things, it just goes to show how more accessible investing actually is. Back in the day, you used to have to pay $5 to $25 every single time you wanted to place an order. I remember just 5 years ago when TD Ameritrade charged a $4 fee for every time you want to buy or sell. But with new apps like Robinhood and Webull, a lot of the other brokerage companies have followed suit and lowered their trading fees to zero. And even though most of them are at zero, you can still have some mutual funds that have a minimal investment policy. That means that if you chose to invest in a specific mutual fund, you may be required to invest with at least $3,000 or more up front. I haven't seen that issue personally in the Robinhood challenge that I'm doing, so I think that if you do find that issue and it's a deal breaker for you, then just try to find another investment option to put your money into. However, now that you have decided on the funds that you want to invest in, what you want to do next is decide what kind of brokerage account that you want to open. I have reviewed a lot of brokerage accounts here on the channel. I have done Robinhood videos, TD Ameritrade videos, Webull videos, and my favorite Fidelity videos, and whatever brokerage you decide to ultimately go with will determine what kind of funds that you can choose to invest in. Some of the most popular brokerages are Fidelity, Charles Schwab, and Vanguard, but if you don't want to go with those brokerages, you can be like me and go with the new kid on the block, such as Robinhood and Webull. A lot of these brokerages offer the same, if not similar, investment vehicles, so I wouldn't get too caught up on picking the right brokerage because ultimately it's about what you feel comfortable with. So if you feel more comfortable with how Robinhood displays its information and that will help you invest more consistently, then I would definitely say stick with Robinhood. But if you want a service with a little more customer support, a company that has a lot more history, then I would lean towards going with the old heads like Charles Schwab, Fidelity, and Vanguard. And then lastly, the most important step if you want to become a millionaire with index funds, and if you don't do this last step, then whatever else I said in this video, you can just throw out the window because it is not important. And that last thing that you want to do is just invest consistently. I recently heard a quote that said 80% of life is showing up. No matter what you want to achieve, whether that's being a millionaire in the stock market, whether that's becoming a YouTuber, whatever you're trying to achieve, 80% of achieving that goal is showing up consistently. So if you're trying to build $1 million portfolio, you can't expect to put $100 in there on day one and never invest any money again. You want to consistently grow over time. You want to consistently get better, and as you get more comfortable with investing, you want to put more and more money into it. The average stock market return is 8%, so even if you put $100 in your portfolio, you would on average be getting 8% a year, which is only $8 on $100. So I would definitely recommend that as you invest, as you grow your confidence, just put your investments on autopilot. Consistently invest on the first of the month, or whether it's the first or the 15th, or whether it's once a week. Put your investments on autopilot so that you will be subconsciously building wealth over time. The book that I read recently called The 5 a.m. Club says that it takes almost 90 days to make a habit automatic, meaning that it takes 90 days to fully ingrain a hobby or a task that you're doing into your everyday life without even thinking about it. And once you reach that automation point with investing, your net worth will start to compound exponentially because the money that you make will snowball on top of each other, and your interest will start earning interest, and you will be steadily getting wealthier every single year. And as you do this consistently, the longer that you have your money into it, the less the temptation that you will have to touch it. If you only started investing 2 or 3 months ago, you're always going to be wanting to touch it, to check it, to try to get something better, and ultimately you may even pull your money out of it because you don't understand the power of the compounding effect. So just leaving the money that you already have currently invested and adding more money to it every single week or every single month will put you on a fast track to being a millionaire. There's also some other tactics that you can use to invest your money more efficiently, like opening up a Roth IRA or actually contributing your money into a 401k account instead of an individual brokerage account. But I think that just for a beginner, as long as you're putting some money towards your retirement, some money towards your savings, and some money towards making smart investment decisions, you cannot go wrong at this stage. Once you have 100,000 portfolio or more, then you may be able to think about starting doing things more efficiently. But at this point, I think the most important thing that you can do is just get started. But if you find any kind of value in this video, then hit that subscribe button for your boy, as I do make other videos about investing, personal finance, and side hustles. And if you do decide to join the community, then I will see you in the next one, guys.